In question 1 of homework 2, we're given an economy. We have the aggregate demand curve given by this equation. We know this is the aggregate demand curve because the slope is negative. We're given the short and aggregate supply curve. We know this is the short and aggregate supply curve because the slope is positive. And we're given the long run aggregate supply vertical line, which is potential GDP or full employment output at 20.087. It just so happens that this aggregate demand curve, which is this black downward sloping line, and this short and aggregate supply curve, which is this upward sloping line, equate at this point here. And this point corresponds to GDP equaling potential GDP. So GDP, the dashed line, and potential GDP, the solid vertical line, are the same, 20.087. If I set this equation equal to that equation, solve for y, I'm going to get 20.087. So initially, real GDP equals potential GDP. When I plug this value of GDP into this equation, or I plug it into this equation, the result in either case is 12.959. So the equilibrium price level is 12.959. And then this is the graph of the initial condition, which you'll have to do on your homework memo. Okay, now I've cleared our graph, and we're going to continue working in scenario 1 here, where we're at this initial equilibrium point. We want to calculate the output gap. Well, the output gap is 0. Why is that? Well, as I said earlier, real GDP is the value of the intersection where short and aggregate supply crosses aggregate demand, and that just happens to be at long run aggregate supply, which equals 20.87. So GDP, real GDP is $20.87 trillion, and potential GDP is $20.087 trillion. So the output gap is 0. In this situation, the unemployment rate is equal to the natural unemployment rate. Because remember, if real GDP is over here, buildings, factories, roads, computer networks are being underutilized. Output is not at full output because of underutilization of all that physical capital. Because we're not fully utilizing our physical capital as a macroeconomy, the unemployment rate is high because people are unemployed. If real GDP is over on this side of long run aggregate supply, we're in an unsustainable boom. Firms are having difficulty meeting really high product demand. So they're hiring workers away from other firms with better benefits or higher wages, or they're working their current employees overtime. So we're in an unsustainable boom over on this side. So here, unemployment is low, meaning it's less than the natural rate. Over here, unemployment is high, meaning it's above the natural rate of unemployment. When GDP equals potential, as is the case here, unemployment equals the natural rate. Unemployment is just right. Okay. In scenario 2, a long bull stock market raises the collective wealth of Americans. Because wealth increases aggregate demand, the resulting aggregate demand equation is given below. This new demand equation is in green because it corresponds to this green line in our graph that we had already previously graphed or labeled. So this is the new aggregate demand line that corresponds to that new aggregate demand equation. The value of the intercept is higher. It was 22.4. Now it is 25.1 right there. The slope has remained the same as it was before. So we have this new aggregate demand line. This increase in wealth that pushes aggregate demand out to 80 prime puts us in an inflationary gap. GDP at the intersection of this new aggregate demand equation and the original short and aggregate supply curve is 22.698. When we plug this value into the new aggregate demand equation or the original short and aggregate supply curve, we get 14.432 either way. Okay, I've now erased the labeling that we did that you'll have to turn in for your homework 2 memo. Let's continue down here on scenario 2. Like I said above, equilibrium real GDP is 22.698. It exceeds our potential. Potential is only 20.087, so we're in an unsustainable boom here, which means unemployment is really low. And when you say unemployment's low, that means unemployment is less than the natural rate of unemployment. Okay? So we need to calculate our economic growth rate. So I'm going to pull open Excel, and I'm going to copy so I got what GDP is, or sorry, what it was, and what it is. I have real GDP and I have the price level. And it was, in scenario 1, 20.087. The price level was 12.959. GDP is now 22.698. The price level is now 14.432. And I need to calculate the inflation rate and the economic growth rate. So the economic growth rate, we've done this many times so far, equals what GDP is minus what GDP was, that difference divided by what GDP was times 100. I'm going to pull this down, and then I'm going to shrink the number of decimal places to 3. Let's see. Yeah, 3 decimal places. Okay. And I'll click on this to show you what we did here. So the inflation rate is what the price level is minus what the price level was. That difference divided by what the price level was times 100 to convert it to a percent. So the inflation rate in scenario 2 from scenario 1 is 11.367%. The economic growth rate is 12.998%. Okay. And then, okay, this kind of inflation is called demand pull. I have a hyphen there. Demand pull inflation. I'm going to hit enter. Check my work so far. And, oh, demand pull inflation with an N. Okay, got to make sure you spell it right. And I get that right. So that is demand pull inflation. Why is it demand pull inflation? Because demand has been stimulated by some factor, in this case the stock market, which has pushed the demand curve out here because people feel wealthy. And as a result, we're in an unsustainable boom. And if nothing is done, if fiscal policy is not changed, if monetary policy is not changed, then because unemployment is really, really low, firms are paying overtime, or they're having to pay new employees more per hour or give them better benefits. That's going to increase the marginal cost of production, which will shift the short aggregate supply curve up to here, and we'll have inflation up here. Okay, so if nothing's done, we'll have even more inflation. And then you'll notice that when we shift up to here, there's been no change in GDP. Okay, so according to the quantity theory of money, velocity is fixed. Remember, the quantity theory of money is this. M, the stock of money, times velocity equals nominal GDP, which is the price level, times real GDP. Okay, so in the quantity theory of money, velocity is constant. We can rewrite this quantity theory of money, this equation of exchange, in percent changes. This is in levels, in dollar values, right? We can write this in terms of percent changes. The percent change in money plus the percent change in velocity equals the percent change in the price level plus the percent change in real GDP. Now, this is the percent change version of that equation. This is multiplication, this is addition, right? So we've assumed that the velocity doesn't change, it's constant. So that's zero. So what we end up having is inflation plus economic growth. Inflation is 11, we said inflation is 11.367, and we said economic growth is 12.998. Therefore, in the classical economics, with velocity equal to zero, no change, so the percent change is zero. The percent change in money is a sum of inflation rate plus the real GDP growth rate. So we'll go back to Excel to calculate this. So this is the percent change in money. It's just the sum of the two, right? Because velocity is assumed to be constant, so this percent change is zero. So the percent change in money must have been 24.365. I'm going to hit enter to check my work. And we got it right. So let me go ahead and erase the writing. Okay, now we're in scenario 3. So in scenario 3, aggregate demand, short and aggregate supply has moved from black to red. And why is that? Let's discuss it. I'm going to go ahead and label this diagram. So remember we got the price level. Okay, so I've spared you having to watch me label this. So we have the scenario 3 aggregate demand curve, the scenario 2 aggregate demand curve, which was caused by the wealth effect from a stock market boom. I'm not labeling this point here because what we're interested in is seeing the scenario 1 equilibrium temporarily shift in the short run out here to this equilibrium where unemployment is really, really low, which puts upward pressure on wages. That upward pressure on wages pushed the short aggregate supply curve up to scenario 3, which is labeled short aggregate supply 3, and result in a new short run equilibrium right here, where GDP is equal to potential. So this short run boom out to here caused by a stock market, a bull stock market, because there was no intervention by Congress, the President, and the Fed to push aggregate demand back down. The low unemployment resulted in a new short and aggregate supply curve that resulted in returning GDP to what it was at full employment and just raising the price level. So in this situation, we get no change in GDP, and we get a huge increase in the price level. Okay. Up here, the shift in aggregate demand from above has caused the unemployment rate, as I said, to rise above the natural unemployment rate. This puts upward pressure on wages. Keynesian neoclassicals argue that this will cause short and supply to shift upward. And hopefully these are the right phrases. I'll hit enter and check my work. Rise above is incorrect. Let's try fall below the natural unemployment rate. Okay, so we got everything correct. Let me go ahead and erase the screen here, and we'll scroll down here. Okay, so now we got to calculate the economic growth rate from scenario 1 to scenario 3. And at scenario 1, GDP is equal to potential, 20.087. At scenario 2, it's 20.087. So the economic growth rate is 0 because it hasn't changed. What about the inflation rate? Well, it is that value. So I'll modify my Excel spreadsheet here. So this is scenario 3. And this is scenario 1 now. Okay? And remember I just said what? That GDP did not change from scenario 1 to scenario 2, or scenario 3. Okay, so from scenario 1, right here, where the price level is 12.959, to scenario 3, where the price level is 15.659 up here, we have a lot of inflation. We have no economic growth because we went from here to here. We did have this short-run boost because the stock market made us all feel wealthier, but because there was no action taken by the Fed or Congress or the President, we ended up with a short and aggregate supply curve back here, which resulted in inflation. Okay, only inflation. So the inflation rate is calculated from scenario 1 to scenario 3. In scenario 3, the price level is 15.659. In scenario 1, it was 12.959. We divide that difference by what it was, 12.959, then we multiply by 100, and we get 20.835 for the inflation rate. Now, again, according to the economic theory of money, percent change velocity is 0 in the classical model. And so the inflation is associated with an equal amount of monetary inflation. So they're the same over the long run. In the short run, we have economic growth. In the long run, there's no change in GDP. So there's no economic growth in the long run. This inflation is all from excessive money growth. Maybe the excessive money growth caused the stock market bubble. So if the Fed is printing money and investors get that money first before anybody else, they're going to probably put it into the stock market, which pushes the stock market into an asset bubble. From scenario 1 to scenario 3, the shifts in aggregate demand and short aggregate supply cause real GDP to increase and, to not change. Sorry, not change. And the price level to increase. According to the quantitative theory of money, 100% of the increase in the price level is caused by the growth in the money supply. Okay, and you'll want to copy the above graphs into your homework 2 memo. Let's go ahead and check this and see what we get. So we got everything correct at this point. Now down here is an alternative view of what's going on above, right? The Fed wants to prevent the economy from going from this point to that point. So what the Fed will do is it will want to push aggregate demand back down. And the Fed wants to push aggregate demand back down, right? The Fed can do that by increasing what is called the federal funds rate, restrictive monetary policy. The Fed can increase the federal funds rate by doing or reducing the quantity of reserves, which is a form of money. So we'll put in parentheses, by reducing the money supply. And that pushes interest rates up. They do that historically with an open market sale, OMS, open market sale. That's where the Fed sells treasuries to banks. And that has historically raised the federal funds rate. And if the money supply falls, the nominal rate of interest will increase. If inflation expectations are constant, then the real rate of interest will increase. And that is what, and investment falls, exports fall, and consumption falls. And those push aggregate demand in. So the Fed, when the Fed gets in a situation where unemployment is really low, to prevent even more inflation, the Fed will raise interest rates to try to push aggregate demand back down. So there is no inflation. So that implies that unemployment can get too low, right? Austrians have a different point of view on this. Okay, so in the Austrian school, when there's a stock market boom, sorry, got to make that dot smaller. In the Austrian school, when the stock market booms, right, or people feel wealthier, or they expect the future to be rosy, we get an increase in GDP, right? We end up with this new equilibrium where unemployment is considered low, right? Unemployment's below the natural rate of unemployment. Now, if nothing happens, then mainstream economists think that we'll end up at this point here, right? Because firms are going to pass off the higher wages in the form of higher prices. But however, in an open economy like we have, there's competition from abroad. So, for example, McDonald's tries to pass off higher prices in the form of a higher price for its Big Mac, or higher wages in the form of a increase in its price on its Big Mac or Quarter Pounder. Americans might think, well, you know what? Maybe I'll just go buy a frozen burger from Walmart, which was made in, say, China, right, or South America, right? So there's this competition from abroad. So in the Austrian world, when there's low unemployment, there's pressure on wages to go up. However, instead of raising their prices, perhaps firms will do what? Maybe they'll innovate. Maybe they'll automate their processes. Maybe they'll install robot welders, or they'll install robot hamburger makers, or they'll get rid of cash registers and install kiosks where people order their food inside the restaurant. So they'll automate. And when they automate, what happens? When they automate, a new industry is created, or new industries are created. So instead, new industries are created. So in the short run, or in the long run, you'll get long-run aggregate supply moving out to here with those new industries. And if long-run aggregate supply shifts, short-run aggregate supply will shift by the same amount. So what ends up happening is we end up out here in the Austrian school, right? So we start here. The feeling wealthier, feeling good about the future pushes aggregate demand out. Unemployment's low. Instead of firms being able to pass those higher wages off to their customers in the form of higher prices, perhaps they innovate. They create new technologies. And when they create those new technologies, when those technologies are rolled out, longer and aggregate supply shifts to the right. And we end up getting a situation where prices don't increase, but GDP does. So in the Austrian view, the price level is constant over the long run, as depicted in this graph, but real GDP increases, and potential GDP increases. Unemployment went low, so unemployment decreased, but then rose back up to the natural rate as people were replaced with automation. So let's answer the questions above. The Austrian School of Economics advocates for governments to not intervene in the interactions between people. If this occurs, Austrian economists argue that intense competition here and abroad, combined with the upward pressure on wages caused by low unemployment, signals firms to innovate. This causes short aggregate supply and long aggregate supply to both increase. Let's go ahead and hit enter here. And it looks like we got some stuff wrong. Oh, sorry. So we got all these things right up here. We just had to answer the rest of the questions down here. So let's go ahead and erase all the stuff on the graph. Okay, so from the initial condition in scenario 1, there is no inflation here, right? We go from this point out to this point, so the inflation rate is 0, right? GDP out here is 25.832. So I'll copy this into my Excel spreadsheet. So, and then the price level in this scenario, we'll call it the Austrian scenario. We'll call it scenario A for Austrian. Okay, in this scenario where people are free to engage in commerce with other consenting adults without intervention from government, instead of worrying about prices causing even more inflation, or low unemployment causing even more inflation through firms passing higher wages off to their consumers in the form of higher prices, when the unemployment is really, really low, firms will innovate. And that innovation creates new industries, and those new industries create or increase long-run aggregate supply and short-run aggregate supply out, which results in GDP growth of 28.601%. At the new equilibrium, because short-run aggregate supply, long-run aggregate supply, and this new aggregate demand curve all meet at the same point, the unemployment rate is equal to the natural unemployment rate. So although there's innovation, there's new industries, and when firms in the short run replace people with technology because the unemployment rate is low, the natural replacement of people with machines with a low unemployment rate and a formation of new industries pushes unemployment back to its natural level. And it looks like we got everything correct.